we move to some question of the portfolio analysis. So factor risk premia on factor J in the arbitrage pricing theory can be interpreted as expected risk premia required on that factor. So we can interpret the APT risk premium similar to the way we interpret market risk premium in CAPM. Each factor is expected risk premia, expected return minus the risk-free rate investor for portfolio. So if it's sensitive 1, the factor sensitive 0 to all other factors called portfolio. APT has all of the following except, so assume that arbitrage, so it does not assume arbitrage, it's an equilibrium model. Assume that asset price are described by factor model. APT assumes no arbitrage is available. Horace Klein buy large cap stocks and shorts S&P index future. What is the investment style? Does clean practices. It's growth, semi-active and active. So Klein uses index future, but that does not make him an indexer. By purchasing stocks and shorting the index, Klein is trying to take index movement out of the equation, leveraging alpha from his stock price. He's an active manager. We don't have enough information to determine whether Klein is growth or value. APT, if arbitrage pricing theory APT holds, it determines. So it determines the intercept term of the multi-factor model. One way to think about ABT and multi-factor model is to recognize that intercept term in a multi-factor model is the asset accept return. APT is an expected return that tells us what intercept could be. So in APT holds, it determines the intercept of the multi-factor model. Which of the following is not part of the general steps of portfolio management? So performance valuation is not a part. Performance is a subset under feedback, but it's not the process. The 3 general steps are planning and execution and feedback in the same order. Let's look at the case-based study here. It says that Jenny Bello, portfolio manager, is attempting to explain asset valuation to junior colleague Bill Clay. Bello explanation focuses on CAPM and particularly is the SML. Bello begins a short review of CAPM, including discussion about the assumption like taxes, holding taxes, etc. Below is the illustrator of SML. Explain how changes in the expected market return can free the line. In effect, to learn, Clay understand the concept that she has explained to him. Bello decided that the test Clay knowledge using CAPM. Below is the information of Clay. Risk-free rate is 7%. Market risk-free during the previous year is 5.5. Standard deviation is 35. Market risk-free is 7%. Stock has a beta of 1.3. Expected growth of 15.5. The covariance of stock B is 0.8. Standard deviation of B is 41%. Zigderversion Clay must calculate expected stock return and beta. Bellows especially wants to know stock age required and whether or not stock is a good buy. Bello then proposes a hypothetical situation. The stock of market is expected to return to 12.5% next year. Clay requests that return estimate in the context of the data listed above, and Bello responds with 4% rotation. The estimated risk premium is incorrect. The interest rate will likely to fall 1 point given that the estimated the market price is over next year. Bello provides Clay with the following information. So for 3 ones we have the beta required at expected return, Ohio, Texas and Montana. These are the probably 3 mining companies. Clay has been tasked with providing an investment recommendation with 3 stocks. Now we have beta required rate and expected rate, expected return of S&P. We the stock beta of A is 1.3 expected returns. Okay, so there are 2 things given to us. The upper side is the stock A and B, and the downside it's this one. So stock A is most accurate, so we can calculate the return of the stock B, which is risk plus beta of stock B. The market risk premium for the upcoming year should be used in calculation. Stock is required higher than expected, so such stock below the security market line. So stock should be sold, not bought. So it falls below the SML. So anything which gives you lower return for the risk should be sold away. Anything that gives you high return for the same risk. The second part is Stock A has a beta and expected to generate 15.5 returns, 16.1. So you should use the new return. And the other thing is you should know the market is premium for the coming year. So if you want to use this, you have to use it throughout the period. The beta of the stock B is so covariance of the stock B market upon variance of the market portfolio squared. So in case you tend to forget this formula, it is covariance upon variance of the market square. Remember, beta is something that would be termless. So if you are using covariance, you already have two terms, and variance of the square would do that. The other would be like you split down this, which is standard deviation of standard deviation or A and B into correlation A and B and so on. Then this would reverse. So one would get cancelled. Part 3, which of the following represent best investment advice? Avoid tax mode because its low expected rate is lower than the required rate. So this is the required rate, this is the expected rate. So I think taxes should be used. So we can use SML to calculate the required rate of return. We have got the beta of Montano. So expected return, required rate of return, Montano should not be purchased. Note that it is even true that Montano expected return more than other stock. It is not enough to compensate for the level of market risk. So however, the expected return is less than the required. So regardless of beta, Texas should not be purchased. Ohio's required rate of 10% expected, hence Ohio is a buy. Assuming that market return estimate of 12.5% accurates of the following best explanation for the estimate. So the expected return on the market during the upcoming year is 14%, 7% plus 7% is minimum. As such, 12.5 estimate does not match the data. The most rational justification for Lowell is the error estimate of the risk premium. Falling interest rate may boost expected stock return, but current rate is most relevant projection. Part 5. With regard to the capital asset pricing model, relaxing assumptions about. So homogeneous expression result in SML appearing more as a band instead of a line. So tax change investor return expectation considering the different marginal tax rate with result in a vast area of different after tax, leading to a vast area of CML SML for different investors. The assumption of no to transaction cost allows investor to make profit even if his stock is slightly off the SML. If risk-free borrowing and lending does not exist, then portfolio risk must be created such that portfolio beta equal to 0. The 0 beta photo is similar to risk-free. Both have beta 0, but they differ as a 0 beta portfolio. If the market risk premium decreases by 1%, when the risk-free rate remains the same, security line becomes flatter. Since the security market line runs through the RFR, holding the RFR constant, decreasing the market will cause the SML to become flatter. Again, there is a big case study. We'll tackle it in the next one. We move to the next one. It says that Chris McDonald, CFA, is a portfolio manager for investment firm that seeks to closely track selected indexes. McDonald is analyzing the return of 7 InvestTrack managed funds. The primary firm MarketTrack or MT track a combination of major stock, bold, real as precious. The stock MT closely follows S&P. The weight of indexes in MT are approximately the same, and they have estimated for these assets in the overall economy. McDonald believes the MT portfolio is more likely to lie on the efficient frontier than portfolio only of stock. In recent discussion with Assistant John Kerner said low correlation between classes, especially real estate, will improve diversification. Kerner proposes that ultimate goal should be to combine assets to achieve minimum variance portfolio on the efficient frontier. McDonald proposed that return of MT portfolio can serve as a better representation of market portfolio than an index like Dow Jones and for example the DJ or industry which may serve as analyst. He asserts that beta estimates using MT will be more realistic representative of systematic risks and will make metas more reliable on decision concerning. Furthermore, he suggests that capital asset line based on MT portfolio should be steeper than the S&P alone. Traeger claims that empty portfolio will have a steeper CAL if the average return of the index other than stock are higher than S&P. Ito responded empty will be higher than S&P only if standard deviation of return of other are lower than S&P. Recently, a customer holding position in TTX stock wanted to explore the purchase of shares in real estate investment trust. McDonald ran a regression of return of stock on returns of the empty portfolio, and he also ran regression of REIT returns on the empty portfolio using monthly return over 3 years. And he made the regression model, return of TTS stocks, return of REIT. The analyzed standard deviation of the monthly return for each of the investment is given to us. The covariance, the standard deviation, the correlation, and the standard deviation. McDonald asked Traeger to compute the variance matrix based upon these results. He also has to compute standard deviation on unexpected risk of these assets. After performing the vision, Kerry investigated that the properties of beta drift after monthly time pass both REIT follow AR1 process. Using AR, he tried to determine the covariance between the two assets will increase or decrease. He assumes that variance of MT will remain the same. After viewing the gathers information that S&P 500 on S&P and find that average return is 1 standard return. The current risk also want to investigate McDonald's assertion of MIT portfolio steeper than S&P should be true. So a lot of information given here. Let's look at them one by one. In Traeger and Ito's respond to McDonald's position on CAL of the empty portfolio should be steeper than that of. So Traeger asserts that CAL will be steeper than average return of non-stock greater than S&P. The fact is that slope, which is also called the Sharpe ratio, also depends upon the standard deviation of MT. Without further information, it is impossible to know if Traeger is correct because his statement clearly cannot be taken into isolation. Ito asserts that CAL will be steeper if the standard deviation of the non-stock index are less than S&P. The fact is that slope, which is also possible, also depends on return portfolio. Without further discussion, so both of them are wrong. Next question says that in response to Traeger assertion that the goal is to achieve the minimum variance portfolio on the efficient frontier, McDonald should disagree under any circumstances. So any portfolio on the efficient frontier with a return greater than the minimum can be combined with risk-free asset to create portfolio that has superior trade-off when compared to minimum variance portfolio. Thus, achieving the minimum would not be a worthwhile goal. So it's like if you remember, we got that curve, but we could still go above the curve by investing in the market and lending the money. With the given information to find CAL of S&P and CAL of the empty portfolio. So CAL of S&P is 0.35. To find the return that gives the slope, Ito solve R in the expression. So if we are given if the CAL is the same, then R can be found out to be 10.6. Figment stock INC has a beta of 1 and a forecast of 14%. The expected return of the market is 14%. The long run inflation expectation is 3%. Which of the following is most accurate? So if the stock has a beta equal to 1, then the expected return of the stock is on the market portfolio, which is also a beta of 1. A fragment expected return is equal to return of required return, and it is properly valued. 19. Answer the following 3 questions based on the table shown. The risk-free security amount for ABC, the respective beta, and the returns are given to you. So beta. Based on the information of the expected return for stock ABC for a risk averse S. So you have to use the line expected return is equal to risk beta into RM minus RF. So you have the return of the market. As you can see, beta is 1. If you observe here, this has got a beta of 1 and a return less than greater than the market. We'll look at that later. So based on the betas, you can find out the expected return of all of them. The next one says based on information which of the stock should be held in the long-term portfolio. So the expected return is given to us. The next step is to expected return for each line with forecasted with the expected forecasted return is greater than then stock is underpriced if F is less than. So A and B are greater than their expected, therefore A and B should be included in the price. So if you believe that they are giving better return than our forecast, then you should keep them. Based on the information about which stock is currently in equilibrium. So none of them are in equilibrium. Stocks are properly priced with lies on the security market line. The forecast return for individual security will be to expect based on CAPM. The first step is to calculate the required rate of return for each security using CAPM and then find out. So we move to the next one. Which of the following statement is least accurate regarding modern portfolio theory? All portfolio on capital market are no, so this is wrong. All portfolio on capital are perfectly possibly correlated. And B and C are right. So capital market line is developed on the assumption that investor can borrow on latent risk-free rate. For a portfolio made up of stock, risk-free and risky asset, the standard deviation of the weighted proportion is the less the risk-free asset. James Barefoot CFS managed the portfolio where she used Dow Jones Index as a benchmark. In past year, the average monthly return of portfolio has been higher than DJ. To measure the active return, you should compute the information which is standard deviation of difference between portfolio benchmark divided by the average of those differences. Information ratio is the measure of active return per unit risk. Let X be the monthly portfolio return minus benchmark. The information ratio is average X upon standard deviation of X. Similar to Sharpe ratio, which define random as monthly return minus risk. Sharpe ratio is average upon standard deviation. What set of portfolio are being determined by the following procedure? For each of the expected return to a single portfolio with smaller variation determined subject to constrain the portfolio weight to assume that there are no risks. So this is minimum variance frontier. To determine the minimum variance frontier, the expected return standard deviation of the set of portfolio that have minimum variances for a given level of expected return. The efficient frontier of efficient portfolio have minimum expected return for any given standard deviation. Its top half of the minimum variance frontier. The capital allocation line results from addition of a risk-free asset to the opportunity set. It runs through the risk-free asset and is tangent to the efficient frontier. Okay, this is a two-part question. Mercy Decker is an investment manager at G&G Investment. She works with a variety of clients who differ in long-term experience, risk aversion and wealth. Diana recently attended the seminar Multi-Factor Analysis. Among the other seminar taught how the assumption concerning the APD model are different from CAPM model. One of the examples used is below. The RF plus FIBI plus F2B2 and so on. Betas for growth, betas for value. If the T-bill is 3%, what is the expected return? So all you have to do is plug the values here. You have the factor and you have the betas for the value. So betas for value and betas for growth. Here you are given F1 the values. So you'll just plug them and find that out. So in one part you have to plug 0.5, 0.7, 1.2. The other part is the factor that the coefficient that would stick to them is given to us. Which of the following is least likely an assumption of APT? So it is not necessary to assume that asset returns are normally distributed. The APT allows for different characteristic of return distribution to be captured by factors in the model. The APT model also does not require the existence of market portfolio, that is mean variance efficient. These assumptions are necessary for CAPM. The APT has serious asset returns are explained by K-factor model. Lower beta operator exists with investor because capital markets are perfectly competitive. Investors can eliminate non-systematic or firm-specific risks through diversification. Words and Vita Enterprise has a beta of 1.6, which we can most likely assume that the future beta will be less than 1.6 but greater than 1.0. So standard error is always expected to be 0. The beta is nothing to be estimate. In the case of March, adjusted beta will almost be certainly lower than current beta. Most of the calculation adjusted beta is 1 by 3 plus 2 by 3 historical beta. In this case, adjusted beta is 1.2. Not everyone will use 2/3, 1/3, but any adjusted beta will result a value between 1 and 1.6. Okay, which of the following is an implication of capital asset based model for investors' portfolio risk decision? So CAPM suggests that all investor will overweigh high beta stock relative to market portfolio. So CAPM suggests that all investors should hold some combination of market portfolio and risk-free asset. Less investor will hold market will move further up the CML, and most will hold the more of risk-free asset and move further down the CML. Which of the following of the arbitrage pricing theory? So no arbitrage opportunity exists. So APT assumes that asset returns are described by multiple factors. There is no enough stock that one can drive that. No arbitrage opportunity exists. Efficient frontier is useful for portfolio management because it significantly reduces the number of portfolio manager must consider. If we are selecting portfolio of large number of stocks, S&P 500 rather than just 2 stocks, number of possible outcome is extremely large. We can restrict our search for possible portfolio combination by focusing on those portfolio on the efficient frontier. We know that they will dominate all possible choices because they offer a higher return for the same level of risk. Which of the following is not an assumption necessary to derive the single factor model? So the market portfolio is the tangency point. That's not the assumption. The result that market portfolio is the tangent portfolio is a prediction of CAPM model, not the market model. The market model assumes that there are two sources of risk, unanticipated macro events and firm specific events. If we use the return of market portfolio as a proxy for macroeconomic factors and assume all stocks have varying degree of sensitivity to this micro factor. In addition, each stock returns are uniquely affected by firm specific events that are uncorrelated across stock with the macro events. Remaining choices are assumptions necessary to derive the single factor model. Which of the following statement regarding the CML is least accurate? So which of them is not right? A is not right. Let's look at the right one. Implies that odd portfolio and CML are perfectly positively correlated. Dominates everything below the line on original efficient frontier. According to capital asset positioning model, if the investor expected return on asset is too high, given that the beta will be, so buy the stock until price rises to a point where expected return is equal to predicted by security market line. CAPM is equilibrium model. The prediction result from market rate focuses to return the market to equilibrium if its expected return to asset template too high, given the beta across the SML, which means that market price is too low. The investor will buy the stock until the price rises to the point where the expected return again becomes the SML. CML is the capital line allocation with the market portfolio as the tangency point. The next one says Joseph Capital is considering implementing a mean variance optimization as a part of their portfolio management. Our firm investment committee is unsure whether the model use historical estimates or market model estimates for their inputs to model. Joseph's senior portfolio trends put together a memo to committee contrasting the methods, and he points out 4 points. He says that point 1, the historical estimate is far simpler and involves fewer assumptions than market model method. The use of market model estimates implicitly assumes that the market itself is mean variance efficient. The use of market model estimates and historical rely on the historical data to some degree. One of the problem with using the market model for estimating return is that market model implicitly assumes the market index is representative of the entire market. After reviewing Palmer's memo, Joseph Investment Committee would correct 2. So the committee would disagree to 1 because the use of historical estimate involves computing the covariance between each stock and with every other stock, while using the market only relies on computing of covariance of each stock and market index. So this result in fewer computation. The committee should agree with point 2 and 3 for the market model regresses historical returns of stock portfolio with the corresponding returns of market index and implicitly assumes that historical relationship are reflective of the future relationship. The market model also implicitly assumes that market itself is mean variance efficient and the index used for market is representative of the entire market. We go to another big one here. It says that Orb Trust has historically leaned toward a passive management style of portfolio, and the only model that Orb's senior management has promoted is the CAPM model. Now the Orb management has asked its analysts to investigate the use of APT. McCrane has determined 2-factor APT model is adequate where factors are sensitivity to change in GDP and inflation. McCrane analysis has led him to the conclusion that the factor risk premium for real GDP is 8% while factor risk premium for inflation is 2%. He estimates that Orb's high growth fund that the sensitivities of these 2 factors is 1.25 and 1.5. Using the APT results, he computes that expected return of the fund. For comparison purpose, he uses fundamental analysis to also compute the expected return. McCracken finds out that the two estimates of Orb high growth fund expected return are equal. McCracken asks a fellow analyst Sue Cohn to provide an estimate of expected return of Orb large cap fund based on the fundamental analysis. Quinn, who manages the fund, says that the expected return is 8.5% above the risk-free return. McCracken applies the APT to large cap fund. He finds that sensitivity rigidity are this one. He wants to learn more about the APT and discuss McCracken says that APT is a variation of CPM and says the extent CPM variability must require additional assumption. Craig and Newland join the conversation. Newland says that APT is another ad hoc multi-factor model. All the researchers need to do to compute the APT model is to find new macroeconomic factors that are correlated with stock return into a simple linear regression asset. McCracken says that the reality is really not that easy. For one thing, according to the different interpretation of how things would go. So McCracken estimates that the expected return of Orb's high growth will be the risk-free rate plus 10% and so on. So the right here is the expected would be the coefficients that you have calculated into the market parameters. The next one says that with respect to McCracken's APT model estimate of Orb's large cap factor and information provides an arbitrage profit could not be earned. So based on the sensitivities to real GDP and inflation, McCracken would calculate the expected return for Orb and and therefore fundamental estimates is congruent with APT estimate. If we assume that both Quinn estimates return of Orb are accurate, then no arbitrage profit is possible. Had Quinn provided an estimate of Orb cap fund expected return, then return was less than 8.5%, then we would have considered selling the fund stock and purchasing high growth fund with the proceeds. With respect to McCracken, Cohn comment concerning the relation of APT to CAPM. McCracken is correct and Cohn is wrong. McCracken is correct in saying that APT is a variation of CAPM. Both the APT and CAPM are equilibrium asset pricing model. For example, both model assumes there is no arbitrage opportunities available. The APT requires fewer assumptions. However, the APT model does not assume investors hold the same portfolio have the same expectation. In conversation with Newland and McCracken concerning the relationship of multi-factor model in general and APT. So the idea here is that APT is a special case of multi-factor model. The two most important distinguished characteristics are that the coefficients in the APT are not simply regressor coefficient from regression into over time factors that have been selected at ad hoc. In the APT, the coefficients are premium for which are asset exposures to certain type of risk. Their values represent no arbitrage condition, which is an important assumption in the APT that in general multi-factor model do not require. The next is that the GDP composed from the other three funds have a weight in utility function equal to. So in order to estimate inflation, the following three equations must be solved simultaneously. So X represents the Orb's high growth fund, Y represents the large cap fund, Z represents the utility fund. By multiplying the equation with 2 and subtracting from 2, we'll get the different weights. With respect to the comments of Stiles and McCracken concerning about the GDP appropriate, McCracken has corrected and Stiles has wrong, both are correct. So since retirees living off steady income would be hurt by inflation, this portfolio would not be appropriate for them. Retirees would want a portfolio return to be positively correlated with inflation to preserve value and less correlated with. Thus, the fund would not be appropriate for retirees, and Style is wrong. McCracken is correct in that the supply side of macroeconomic policies are generally designed to increase output at maximum inflation pressure. Increased output would mean higher GDP, which in turn would increase the fund positively. Which one of the following is not step in the portfolio management process? So development of an IPS is not about management. Once you develop it, then you don't have to work upon that. So a small difference there. The CAPM line हाँ दिलीप, हाँ तेरा रिचार्ज करना है? अच्छा ठीक है, चल मैं कराता हूँ। इसी नंबर पे कराना है? अच्छा ठीक है, कौन सा करूँ? 1000 मिनट वाला? अच्छा ठीक है, चल मैं कर दूंगा, है ना। हम्म। So CAPM market line is to determine the percent allocated to the market portfolio and risk-free asset, both remaining the SML. Frederick Kurzon-Kutzky, CFA, employs a 10-hour black portfolio optimization model at his firm, TBP, where he serves as portfolio manager. TBP recently decided against holding short position in their portfolio. Because he asked to determine the most result in short sale prohibited on the votes allocated to long and to alpha. So Kaur should make the following two prediction about the effect of prohibition of such allocation to long process. Allocation to long processes would decrease and alpha would decrease. So the idea here is quite interesting, that prohibition of short sale removes negative weights on actively in stock along with the leverage position on that short offered to the long position. Where short sales are allowed, more than 100% are not allowed, only 10% can be allocated to long result. Therefore the prohibition of sell cause weights to long term within the actively portfolio to fall. The alpha is also equivalent, smaller weight and now some to positive alpha stock, no negative to negative alpha stock. Gemini Investment Management Company assumes that market will remain at equilibrium indefinitely. The GIMC defines security analysis as the examination of factors affecting the value of individual securities. GIMC defines asset allocation as the examination of factors affecting the optimal allocation of assets to the market portfolio and to the risk-free asset. Given GIMC's assumption that markets are at equilibrium indefinitely, indicate whether GIMC should place significant or insignificant emphasis of security selection and asset allocation. So when markets are at equilibrium, all asset prices will be equal to their fair values. Assets are neither undervalued nor overvalued. Therefore, if GIMC believes market will remain at the equilibrium indefinitely, then they should place very little, if any, emphasis on security selection. In contrast, active portfolio is needed to determine the appropriate allocation of client investment between market portfolio and risk-free asset. Active portfolio management is needed to forecast the expected return and risk of the market portfolio and to forecast the risk and return of the risk-free asset. GIMC should allocate large percent to market portfolio for higher risk tolerant client and high percentage to risk-free asset for the risk averse client. Significant effort should be expended to determine the appropriate mix of asset for the client. Which of the following not describes the arbitrage? So these things like 5 factors and so on are not there. So it's an equilibrium model like CAPM. It requires a weaker set of assumption than CAPR to derive. APD is a K factor model in which factors of K are assumed to be a lot smaller than the number of assets. If no specified number of factors assumed depending on the data used with the model, there may be few as 2 or more as 7 factors. According to CAPM, if the expected return of the asset is too low given its beta, investors will sell the stock until price fall to a point where the expected return is again equal to the predicted by the security market line. CAPM is an equilibrium model. Its prediction result for market forces acting to return the market to its equilibrium when the expected return on asset is temporary too low given its beta according to SML, which means that the market loss to an investor will sell the stock until the price falls to the point where expected return is again equal to predicted by the SML. The best possible risk return trade-off at table given the investee is expected of expected returns, variance and covariance is represented by, so that is represented by slope of capital allocation line. We can interpret the slope of capital asset line the same way the slope of any straight line, which is change in ERT for unit change. Thus the representation of risk-free trade move along the scale. How much additional expenses do we get 1 unit increase in the risk because tangent portfolio T is the best value. The slope of TL line represent the best possible risk return trade-off at table given the investors expected return variances and covariances. However, capital market line and the SML similar. So all portfolios will plot on SMS. The only portfolio will plot is the market portfolio because it is perfectly diversified. In a multi-factor macroeconomic model, the zero mean error represents. So the zero mean error term represents the unsystematic firm-specific diversifiable risk that are not explained by the systematic factor. So that is in the multi-factor economic model, the zeros represent the unsystematic firm-specific diversity that are not explained by the systematic factor. That is mean zero error term. In any term, the error represents something that is not explained by the regression equation. Portfolio Management Associate provide asset allocation advice for pension. PMA recommends that all the pension clients select an appropriate weighting of the risk-free asset and the market portfolio. PMA should explain to its client that the market portfolio is selected because the market portfolio maximizes the Sharpe ratio. So the risk and the return coordinated for market portfolio is the tangency point for capital market line CML. The CML has the steepest slope of any possible portfolio combination. The slope of CML is the Sharpe ratio, therefore Sharpe ratio is highest for the market portfolio. So the following statement more accurately describe capital asset line and the capital market line. So the correct answer is between laws on CML. When a minimum variance portfolio is constructed on a risk-free where y-axis is expected return, x is standard, the capital allocation line is the line emanating from the risk return through the highest point of tangency with the minimum variance frontier. When the point of tangency is the market portfolio, the capital allocation line is the capital market line. Adam portfolio consists of 35% Khalin equipment stock and 65% Giant Semiconductor stock. Analyst Joe Carroll estimate 40% of Keynes return variance is determined by cost trend and 60% is determined by purchasing trend. And he has find out that the expected return plus cost factor plus purchasing factor. Estimates that Giant return variance is 75% determined by cost trend and 25% purchasing trend. With an estimated return of 7% for Keynes and 16% for Giant, and given the cost factor of 0.07 and a purchasing factor of 0.0325, the Adam portfolio expected return is closest to 9.7%. To calculate the expected portfolio return using the macroeconomic model, we simply use the weighted average of the model. Here are the models. So we'll just put in the values there with the factors and get the value. Keskin stock has a beta of 1.2 and this is stock of 1.6. Which of the following is more accurate? So beta is a measure of systematic risk. Since only systematic risk is rewarded, it is safe to conclude that expected return will be higher to Keynes stock than Quinn stock. So it is safe to conclude that 1.2 beta will is expecting a higher return than the other one. Zhongfu CFA uses the SML to determine if stocks are undervalued or overvalued. Who recently completed analysis of Sang tractor supplies and derived the following forecast for STS and the broad market. Forecast return for STS 10%, standard deviation forecast for STS 15%, expected return on stock market 12%, standard deviation on stock market 20%, correlation between STS and stock market is 0.6, risk rate is 6%. To determine the fair value of STS, Wu should use the following risk values and should make the following decision: risk value and valuation. So the security market line has the framework for this analysis. The appropriate risk measure for SML is the stock beta. Just remember the formula. There are two forms of the same formula to calculate the beta or the slope or the sensitivity. It's covariance of your stock with the market upon standard deviation of market square, or if you convert the covariance into correlation, one market would get cancelled and on the top you will have correlation into standard deviation of your stock upon standard deviation of the market. We have given that and we can do that. So to determine the fair value, you must compare the forecasted return against the equilibrium expected return using his SML, the equation for security market line, which uses beta. So forecast 10% exceed the equilibrium. Therefore, we should determine that estimation is undervalued and you should buy the stock. Which of the following factors are least likely to affect formulation of an investment policy statement for a university endowment fund? So tax consideration. After endowment fund would be tax exempt, they would have to include not include taxation formulating investment fund. So the endowment fund have to use social and multi-stage consideration. Ophelia Magletlia, retired airline executive, has been buying and selling stocks for more than 50 years. At 74, she controls a modest investment portfolio of 280,000. Over the last year, Magletlia has given away millions of dollars to charities. She lives comfortably on the pension and her deceased husband's social security benefits. Magletlia keeps the bulk of her investment in stocks, although her children and grandchildren say that she is taking on too much risk at their age. So McLaren should be most conservative about. So given McLaren's ability and willingness to take a risk, liquidity is not a concern. We have no reason to believe that income will not support other, and we have no pricing needs for the investment fund. As a result, while a high stock weighing may look odd on paper, considering his age is not necessarily inappropriate, particularly if she is investing for growth to fund charitable donation or children inheritances. Tax, however, concerns most investors given relative insensitivity to postal tax conditions seems to be the biggest potential problem. So sensitivity to two options, tax is the biggest problem. Joe Smollett has been investing for years, mostly using the index fund, but because he is not satisfied with his return, he decides to meet with Bill Smale, a financial advisor at Big Gain Asset. Morris lays out his concern about active management. Mutual funds average return below their benchmark. All buying and selling makes them less efficient. Expenses are high for active. Analyst forecasts are often wrong. Effort to win market business. Smale explained that benefits of active management start the fact that market efficiency is a prime concern for it because efficiency makes managers possible. He explained that active managers allow for better protection against systematic risk and big cases multi-factor to adjust on for economic changes. Lastly, it tells how Gain Assets has pledged never to reveal client funds to third parties. Morrell seems willing to listen, so Small explains Big SM strategy, which involves a modified version of CAPM using Dow Jones Total Market Index. He reveals that the valuation model citing the ability by the future will determine true value of market beta for individual stock, creating an accurate picture of market portfolio and provide alternative for calculated covariance in charting of Marcos efficient frontier. After an hour of verbal sparring with Small, is not yet convinced of wisdom of active management. He turns to top goblin, calls Hussein Ward, the college friend, who works in listed liquidity department. Top uses the arbitrage pricing theory to value stock. Warden explains that ABD offers several benefits to CAPM. After listening to Warden explain the ABD, Moss asked her how the theory is dealt with the mispriced stock, drawing a table with the following data to explain the current price, correlation, standard deviation, beta, current price, estimated price in 1 year, correlation. You have got the price in 1 year, which is as good as having the return for 1 year. After seeing Mohsen's stock example, Moss tells him that he should not understand ABD and tries to explain how theory deals with Mr. stock, which of the following is correct. So arbitrage pricing theory holds that arbitrage opportunity will be exploited immediately, making the mispricing theory. So the only idea is that mispricing would get immediately rectified. The next one is that which of the following is least likely an assumption of market model. So the assumption that unsystematic risk can be diversified away is an assumption of arbitrage pricing theory, and that is the reason why this is not the right option. So you are more interested in finding out the expected term and from specific surprises, but you don't assume that unsystematic and diversified by arbitrage pricing theory. Systematic risk can be diversified. Unsystematic risk cannot be diversified. A Small best makes his point about the superiority of active management with the mention of multi-factor model. Systematic risk cannot be diversified. There is no dependence that active management help control it. Active management attempt to capitalize on efficient market and a truly efficient put with an effective management. However, multi-factor models are useful tool for active manager, and high quality model may indeed represent a competitor of passive manager. Which of the following assumption is required both by APT and CPT? So added prices are not discounted for unsystematic risk. This is the conclusion. So the assumption that all investors have the same expectation and there is no transaction cost are specific to CAPM, not to APT. However, both models assume that unsystematic risk can be diversified away and has a risk premium of 0. Which of the models' argument against active management is least accurate? Which is all buying and selling makes a far more less efficient model is not accurate. This will bring the prices more better. So this is not accurate. Expenses are higher with, that is accurate. Mutual fund, that is accurate. Assume all his numbers are correct. Portfolio allocation 65 and 65 second stock would have arbitrage property. So if you assign both of them, you get a return of 1.21, the same as beta of ESN. The weighted average return of combination is 11.6 versus 12.8 returns for your buying units and selling your portfolio would earn an estimate of without investing any capital or taking out on any systematic risk. So if we assume all data is right, then we can probably gain from this strategy. Investment management use the capital market line to make asset allocation recommendation. IMI derives the following forecast: the expected return on market portfolio, standard deviation of market for risk-free rate. Samuel Johnson seeks IMI advice for a portfolio asset allocation. Johnson informed that he wants the standard deviation of the portfolio to be equal to 1 of the standard deviation for the market portfolio. Using capital market line, the expected return that IMI can provide subject to Johnson's control is closest to. So the equation for the capital market line is closest to risk-free, and the Sharpe ratio into the risk of your portfolio. So require the portfolio is equal to 1 of the market portfolio standard deviation. The market portfolio standard deviation is 20%, therefore Johnson portfolio should have a standard deviation of 12%. The intercept on the capital market equal to risk free plus the slope line equals to the Sharpe ratio for a portfolio 35%, therefore using the capital market the expected return on Johnson portfolio will be equal. A single factor model assumes that how many sources of risk is returned. So a market model assumes that there are two sources of risk in the unidentified macro and the firm specific risk. So that is the market model. Corner Kane shares have a beta of 0.8 and alpha of 40%. Conner's adjusted beta is. Now the adjustment beta where A0 and A1 will sum to 1, and if A1 is 40 then the other one would be 60. You apply both of them. If you see that the past value is 60% and the current value is 0.8, so that will make it to use 0.92. Then we have another case theory here which has got a lot of information. So this one is a big one. Colonial Capital leans heavily on the CAPM model in investment banking decisions, but the company's analysts find it difficult to use. In an effort to make the calculation easier, Colonial has modified the CAPM to use S&P 1500 composite index as a benchmark. Colonial recently hired a powered money manager Majoricap, kept them from rival in an effort to boost its lagging returns. Comp understand that the appeal of CAPM so he is looking for some other fund. In her act as chief investment officer, Conan Kemp sends a memo to all portfolio managers, instructs them to start using alternative method for allocating assets. She opened by touting the benefits of other assets. CAPM requires a lot of understanding. APT is far less restrictive. A major benefit of is that ability to efficiently test it, and under APT is easier risk is easier to control for beta estimates. Neither multi-factor model nor APT requires an estimation of market risk premium. Kemp then called the meeting with Colonial's analysts to discuss asset valuation strategies. The debate grew spirited, and a long time Colonial analyst named Smith says that the company has experimented with multi-factor models years earlier and did not come with a model that satisfied everyone. Then they proposed a number of multi-factor for different portfolio. Said that it did not like APT because it did not indicate the risk factors were. Said that it liked because it acknowledged the arbitrage opportunity occasionally exists. English says that it disliked APT because it not to come out of the market portfolio. After about 30 minutes, Kemp realized that nothing productive occurred, so sent everyone to work analyzing a valuation model. She wrote the following equation on the blackboard: expected return on the stock is S&P index by 2, capacity utilization plus 1.52 GDP growth plus 2 into inflation. Which factors take into combination would create the best multi-factor model? So we are asked like which factors would be best. So without knowing the accuracy of the factors and your actual look at the number generated by the equation, we can analyze the development by considering whether the individual factors are relevant. Winter, low temperature and energy price are particularly relevant to utilities, the first on revenue side and second on cost side. Because utility tends to have highly leveraged interest rate, inflation relevant ratios, housing stat relevant for utilities as houses a large apartment. But utilities are considered diversified in the returns and less correlated with those of broader market than the return of asset sector. Also, sector is less correlated with economic growth, as more the model considered GDP growth or market return are probably less value than one of the model considers needed. Which statement represents Kemp's weakest argument? So the weakest argument is that under APT risk is easier to calculate than the case of Kemp for beta must be estimated on observed return. So it's debatable whether risk is here to undercalculate. True, the beta of is thus not needed, but risk factor is required for APT. Questions are not provided. Analysts must select them as such. A statement about the ease of calculation is open for interpretation. Both remaining statements are actually accurate and no interpretation is required. Kemp's equation is closest to a macroeconomic multi-factor model. So arbitrage pricing theory and the capital asset pricing equation uses risk-free return. So Kemp's equation is not APT, that leaves factor model. The market return is technically neither a macroeconomic nor factor, but it can be used for multi-factor model. Since the other three will represent a macro factor, the equation is closest to a macroeconomic multi-factor model, which analyst made the most sense. So Floro's statements about risk factor is correct and reflects weakness of APT. Clara's statement is incorrect because one of the assumptions in APT that arbitrage operator do not exist. Engage is mistaken because APT does not require the use of market portfolio. Analyst can certainly use the market portfolio as a factor if required. We look at the next one here. It says that an efficient frontier enables market manager to reduce the number of possible portfolios considered because the portfolio on the efficient frontier have the highest expect for leverage that other portfolio. This is simple. A defined benefit plan would most likely have one of the following set of return objective and risk tolerance. So pension fund liability plus inflation. Risk tolerance is like a funding status from plan, age of worker. For a defined benefit plan, a return requirement are based upon need to fund the pension liability while accounting for inflation. The risk tolerance depend on the plan's feature, the age of the workforce, the funding of the status plan. MPT Associates select optimum portfolio using Tranor Blake model. Randall Morgan and Carr's research associates with MPT debate the assumption of the model. Morgan stated the model assumes that large number of assets are middle-sized. Elements stated that the model places high importance on diversification. Regarding these two steps, so Tranor Blake combines modern portfolio theory and market efficiency. The model is based on the premise that markets are nearly efficient, implying that the number of mispriced assets is small. Therefore, Morgan's statement is not correct. In contrast, Everson's statement is correct. The Tranor Blake model incorporates active security selection with an optimally diversified portfolio context. Thus model places a very large importance on diversification. Consider an equally weighted portfolio comprised of 5 assets where average asset standard deviation is 0.57 and average correlation between asset is minus 0.21. The variance of the portfolio is closest to. Now this is a new formula not encountered till now. Let's look at them. So portfolio variance is 1 by n into to the standard deviation of 1 square plus n minus 1 divided by n into the covariance. First we have to find out the P12 and therefore the covariance is 0.68. Then we have to find out the standard deviation, which is 0.32, and it's like 1.5 into standard deviation plus n minus 1 upon n into the covariance. Now this is the formula of having many things. Now if you closely observe this, we can derive this, but I'll talk about the basic idea here. The second term is like selecting a lot of portfolio. It comes from a formula of permutation and combination kind of a thing, and where we have like many portfolio, we build up those models and ease out things. So just remember the formula: 1 by n into square of standard deviation or variance. The other is n minus 1 upon n. Just observe that we are slowing it down into covariances. If it's not there, then it's just 1 by n into standard deviation of 1 the square. The macroeconomic factor model for return of Omni and Gerbo factories is like GDP, QS, etc. What is the expectation? 60%. So if you are invested in 60% and 40%, then you will use the same values in both of them, and then you will multiply 0.6 into 20%, 0.5 into 50%, plus 0.6 into this and 0.5 into this. So everything, when you do that, you can search for the numbers and use them, but the idea remains that if you observe closely here, the coefficient is FGDP, so that would remain constant, and few of them would multiply with the error term. So things would get cancelled out when you multiply 60 into this and 40 into this. So this is like 0.6, this is like 0.5 into 0.4, and so on. So 0.6 into -1 plus 0.4 into -5, and so on. Gary Zeller, an independent portfolio manager who manages money for high net worth individual, is proponent of the efficient market hypothesis. He uses Tranor-Black model to estimate asset allocation for his portfolio. At the moment, he is considering several investments for new portfolios. Here are the characteristics: expected 12-month return, residual standard deviation, and beta. Risk free is 4.7, expected returns in risk standard is 14%. Then plan to create a portfolio using mix of S&P, the risk free, and the 4 stock discussed above. Uses the data to select the appropriate asset allocation that maximizes return. Recent market activity has Zeller concerned. For several weeks, he has been stock with a weak fundamental stage and a strong rally, while solid steady growth have lagged. After extensive research into technical trends and analysis of market fundamentals, Zeller has come out to believe that recent trend in market is likely to continue, with speculative stock continuing to rally. Despite the gains in speculative stocks, Zeller sees continued weakness in larger stock. Solid stocks, causing a decline in S&P 500 ranks. To compensate for this, he purchases put option on the 50 largest stock in capitalization weight index instead of buying stock itself for new portfolio. Later that, as email Tranor makes the following assumption: the strategy is designed to beat the market model, but not necessarily generate gains when market is down. In your portfolio, I overweight the stock with highest potential return. A mix of individual stock and index future give up the portfolio better potential result than index, while offering less risk than individual stock. All of the stock has beta below 1. After sending this, then open the spreadsheet to crunch some number. Several of his portfolio has underperformed over the last year and resolves while he should relax his assumption. From highest allocation to lowest, Jansen should allocate for portfolio 2. So standard residual standard deviation and expected return. You have beta. You can find out the actual return. You can find out the alpha, and you can find out how good things have been behaving. And then while after doing that, you can find out the one that is the best. Which of the Zeller actions is least compatible with the use of Tranor-Black model? So his support for purchase of put option. Index fund appeal to be efficient. Market theorists in the part believe that because they offer a low cost of investing in the market without trying to exploit frequent pricing, while active management of any sort may seem incongruous with the efficient market backdrop. It's an active management or the search for offer that clears up mispricing and theoretically leads to market equilibrium. The Tranor-Black model is an optimization framework that assumes markets are nearly efficient but does not allow for some active management. The Tranor-Black model assumes that a portfolio consists of index fund, stock, and risk-free asset. Put options have no place in that model. After the Zeller points in his weakest defense of the Tranor-Black. So which is the weakest defense? All of stock in has so strategies based on a mix of index and individuals not like to generate gains during period when index fall, but they are still able to beat the market if individual stock is selected well. Zeller comment about diversification is true and at the heart of the Tranor-Black model. The statement about overweighting high rock is not particularly a good argument because the model also calls for underweighted stock that has high unsystematic risk. But the worst involves beta because Tranor-Black does not take beta into account directly. In the light of his observation about market movement, Zeller should increase his allocation in the active managed stock. So as the market become more efficient, alpha shrinks and the portfolio manager using Tranor will reduce the allocation to active stock. However, Zeller expects more mispricing to increase in the coming months, so he should step up active management of his portfolio to take advantage of higher alphas. If Jenner stop assuming forecasts are accurate, he will most likely reduce both risk and potential return of the portfolio. If the tenor assumes the forecasts are accurate, relaxing that assumption require analysts to place less weight on forecast. If we discount the value of forecasted alpha, the weighting of active portfolio will decrease. A higher index weighting is likely to reduce both risk and potential. The less trust we have in forecast, the more forecasted alpha is required to justify making a bet on individual stocks. Stocks with marginal alpha will become less appealing, so the number of stocks available for investment will decline. The number of stocks in portfolio is more likely to decline than increase. CAPM is very different from Treynor-Black model, and accounting for inaccurate forecast does not change that. Portfolio rebalancing is not useful here. Assuming Zeller intends to take position on all 4 of the stocks discussed above, how many should he sell? This is all for a positive example. None of them should be shorted. Which of the following assumptions is not necessary? The EAPT. So the price, factor, risk and hedge without taking short position in any portfolio. This is not an assumption. Large numbers of resistance are discussed by K-factor model. That is also right. Assets are described by factor model. A large number of which means investor can create a diversified portfolio which form facilities eliminated. There are no arbitrage opportunities available to investor among these well diversified portfolio. An arbitrage position is an investment that has an expected positive net cash outflow but requires no initial investment. Which one of the following statement about the CAPM to value stock is least accurate? So CAPM reflects unsystematic risk, uses standard deviation. That is wrong. CAPM assumes all investors hold the market portfolio, and as such unsystematic risk is not related to market does not matter. Thus the CAPM does not reflect any unsystematic risk, does not rely on standard deviation as a measure of risk, but instead uses beta as the measure of risk. The remaining are accurate. So the model reflects how market force to equilibrium level. The CAPM expect return is too low and the assets price is too high. The CAPM pricing model is a market portfolio, and the CAPM does not reflect unsystematic, it does not rely on standard deviation, it instead uses beta as a measure. Now we have 2 stock portfolio consisting of the following. The portfolio consists of a stock of green company, portfolio weight 30 and blue 100 from 2070. Green's expected life is 12% and blues is 8%. Interest rate are expected to be 6%. Oil prices are expected to be 2%. A 2-factor model for green company R is equal to 12% minus 0.5 into FINT minus 0.5 into FOIL plus E green. A 2-factor model for blue companies R 8% plus 0.8 FINT plus 0.4 FOIL plus E blue. If interest rate are actually 9%, oil price is not rising, the return is. So if oil price is not rising, interest rates are actually 9%, then what would happen? Now the R in blue, you have to use the same data and you have to make sure that you use all of them. So factor of interest rate, oil price does not rise, and you have to calculate price of the portfolio. So the idea remains that we use the factor to find out what would actually happen and use that thing accordingly. Question 29. A money manager who crafts portfolio using all of Standard and Poor's sector exchange traded funds, aggressively overweighting and underweighting stock, follows the investment strategy. Semi-active stage involves using index as the underlying investment but trying to add value through some active management. In this case, management starts with ETF but actively adjusts the allocation. He is a semi-active manager. Then we have a case-based study. Ben Tanner, a new associate at Global West Investment. Tanner approaches supervisor Eric Smith with some questions about risk. Specifically, Tanner lacks a complete understanding of many portfolios, including the following: how the presence of a risk-free asset will affect the efficient frontier, the difference between total risk, systematic risk and unsystematic risk, market and macroeconomic model. Tanner is concerned with providing the best investment advice possible for him. He seeks advice for some of his former Midwestern college friends who now happen to be CFA chart holder. One of his old roommates suggests that he looks into the market model or multi-factor based on APT. Tanner researches An alternative pricing model starts to become confused as all equations look similar. He writes of the following notes from memory. Intercept from market is derived from the APT. Intercept of the APT is the risk-free. The intercept of macroeconomic is expected on a stock when there are no surprises in the model. So intercept is expected return. Simon makes the prediction for Tanner as shown beta stock correlation standard deviation. Expected return. Tanner uses market model prediction S&P for a proxy of market portfolio to calculate the covariance of stock B and C. Using the market model, he determines that systematic component of the variance is equal to 0.048. Now he heads out to meet a friend, Del Torres, for lunch. Torres excitedly tells Tanner about his last work with tracking and factor portfolio. Torres says that he has developed a tracking portfolio to aid in speculation on oil prices and working on factor portfolio with specific set of factor sensitivities to Russell. Which one of the following is the most appropriate response to Tanner's question about the presence of risk-free asset and the Markowitz efficient frontier? The presence of risk-free asset changes the characteristic of the Markov frontier by converting Markowitz efficient frontier from a curve into a linear risk relation dataset. The presence of risk-free asset changes the characteristic of Markowitz efficient frontier by converting the Markowitz efficient frontier from a curve into a straight line called the capital market line. The next one says which of the following statement best describes the concept of systematic risk. So systematic risk is the remaining risk for a well diversified portfolio. The unsystematic is like a company not performing well, or some loss in a particular company, or some unexpected event happening. Are trainer notes on the intercept for pricing model correct? No, because the intercept for the market model is the return on the stock when return on the market is 0. No, because intercept APT is stock alpha. No, because intercept market is. So the intercept of market model is the return on the stock when the return on the market is 0. Trainer is incorrect with regard to market model. The intercept is equal to return when market is 0. Trainer's other two comments on the intercept is right. So if you look at here, the intercept of market model is derived from the APT. Intercept is the risk free. There are no surprises. So market model he is wrong, which means that he is wrong for the first one. The beta of a stock A is closest to, again a standard formula. According to the prediction of the market model, did Tanner correctly calculate the covariance of stock B and C, and stock B is a systematic component of variance. So Tanner incorrectly calculated the covariance and correctly calculated systematic value component. According to the market model, the covariance between two stocks is calculated as a product of their betas and the variance of their market portfolio. Here S&P is a proxy. So proxy for market covariance between two is covariance Ij is equal to beta Ij into standard deviation of market the square, and COVB and 10 is the standard deviation of the market. The variance of the return on asset I consists of two components: a systematic component related to assets beta and another related to firm's event. For stock B, the unsystematic component is 0.48. Did Torres correctly describe the tracking error for the factoring portfolio? So reverse the concept. A factor portfolio is a portfolio with a factor similar to a particular factor 0 to all. Represent a pure bet on one factor and can be used for speculation or hedging purposes. A tracking portfolio is a portfolio with a factor set of sensitivities. Tracking portfolio are often designed to replicate the factor exposure of a benchmark index like Russell 2000. Let me see if this is a case based one. This is signal one. William Partley, age 69, has had bad luck with investment in recent years, designed to consult Morgan Stanley CFA for advice. Motley portfolio is composed of 90% stock and 10% bonds with a total value of 2.6 million, classifying as conservative. Partly blamed the aggressive allocation on previous money managers, so he wanted to substantially increase fixed income weighting of the portfolio. For his portfolio, Partley hoped that his retirement rate at $7,000 per month adjusted for inflation. He also promised his alma mater at least $2 million upon the death. Pether is good health and most of his family have lived into their late 80s. Based solely on the information, Wembley can conclude that there is most likely a conflict between willingness to take risks and ability to trade. His portfolio is large enough to meet his needs and some of his rooms to separate. His annual account just account for 3.23. That's 2.6 million. of the portfolio. Even accounting for inflation tax, 7% of it will probably be enough to support Paisley without dipping into principal. Furthermore, with 60,000 cushion above the 2 million mark, the need for bequest, Paisley can afford to dip into principal if necessary. As such, his desire to move out to more conservative allocation is not in conflict with his requirement. Partly wealth and modest return suggest that he has substantial ability to take risk. Yes, partly considers himself conservative. So there is a conflict here. Jennifer Barefoot CFA is managing a portfolio for a client who asked Barefoot to use the DJI as a benchmark. In the second year, Barefoot uses 29 of the DJI stock. Selected non-GI stock in the same industry as omitted GI stock to replace the stock compared to GI. Barefoot closed a lower weight on the communication stock and higher. Over that year, non-GI stock in the portfolio had positive hand return than the omitted GI stock. The communication stocks have negative return while positive. The portfolio management outperformed the DJI. Based on that, we can see that the return from TRIDS essentially was. So, since the communication stock had a negative return while all other stock had positive return, Barefoot underweighting of those stock produces a positive tilt. Since the asset chosen to replace DI outperformed the measure, the asset selection was positive. So if we look this from a ethics point of perspective, if somebody has said you something, then you cannot do that. But in the portfolio world, you are the active manager, so you can use your ideas. Which of the following concerning the macroeconomic multi-factor model for return on stock J least accurate? Expected return is 12%. F1 F2 represent price risk. Return on stock J will decrease, factor 2 is expected to increase. So B is wrong. In a macroeconomic multi-factor model, only expected changes in systematic factors are priced in the sense that they affect stock rate. Return in stock will decrease if factor 2 increases unexpectedly because the factor sensitivity is less than 0. Expected result increase will not cause it to increase. The objective return 10% is an example of required return. So the objective return 10% required return because it represents some level of return that must be achieved by portfolio. So the following best completes the following statement. The CAPM is a subset of APT model. APT is less restrictive than CAPM. It does not require the assumption that investors have quadratic utility function, securities returns are normally distributed, or the existence of mean variance. The CAPM is a subset of APT where it is assumed that only relationship to the market portfolio is used in explaining research. The APT is more flexible because it can have K factors. However, these factors are not defined in theory. The portfolio manager uses a two-factor model to manage her portfolio. Two-factor model are confidence risk and time horizon risk. If she wants to bet on unexpected increase in confidence risk factor, which has a positive return, but hedge aware expert to time risk horizon, which is negative risk, and she should create a portfolio with a sensitivity of 1 to confidence risk and 0 to time horizon. So we want to understand what is factor portfolio here, that we want to target a particular factor. So she wants to create a confidence risk portfolio which has sensitivity of 1 to confidence risk factors and 0 to time horizon, because the risk premium on the confidence risk is positive and unexpected increase in this factor will increase the return of the portfolio. The exposure to the time horizon risk factor has been hedged because of the sensitivity risk factor is 0. Response to instability in minimum variance frontier is likely to include improving the statistical quality of input and adding constraints against short sale and value multiplier, reducing instability in the minimum variance frontier. So we'll look at some of the points here, not the questions. APT implies that investor will undertake in infinitely large position long and short to exploit any perceived mispricing, causing asset to adjust immediately to required values. The alpha returns are beyond the acquired rate of return.